issues with you. Here's one. You usually give us an update on what's happening on the West Coast with the dock workers contract. Where are we now? Have they asked for your involvement at all?
No, I mean, I've been in steady contact. This week I talked to all sides. They were able to work through some of the more tricky issues out there. They have not asked per se for me to come out and talk to them. I did go out January 2nd to sit down and talk to the companies and some of the union guys out there, union people out there. They're moving along. Certainly, as I said to you a long time ago, I wish this negotiation was done, but there's a lot of issues out there that they want to go through. But so far, hopefully, we don't have anything that will hold this contract up, but certainly it's something I'd like to get done sooner rather than later.
You've been pretty calm about it, and I often ask you, when does the red light start to flash? Are we getting closer to that point for you?
No, it'll flash to me if there's an issue that I think is going to be one of those make or break issues. You know, like in the railroads, when we talked about you know, the negotiations weren't really going on as they're moving forward. When sick time came up, paid sick time came up, I kind of knew that was one of those red flashing problems. I haven't seen that yet in the ports negotiations, and I think that, you know, the way they work is a lot of the unions work and negotiate with individual ports, but there is a master contract. I don't know if that's the technical name for it, but right now I'm not concerned about that yet. I mean, listen, you could change on a dime, obviously, but right now I feel good.
Secretary Walsh, usually Tom Keene and I like to talk about football, real football, the stuff that happens outside of the United States. I'm told you're a massive Bruins fan. Is that true?
I like the Bruins, I like the Patriots, I like the Celtics, and I also like Man United.
Oh, you do as well. The reason I bring up the Bruins is because there's some interest in perhaps maybe you going to the NHL Players Association. Any truth to that, Secretary Walsh? There was a report from Politico this week.
I don't have any personal news to make today. Today I'm focused on a jobs report that has shown since the President Biden has taken office, 12.1 million people have either gone back to work or jobs been added to the economy. And you know, certainly this is such an honor being Labor Secretary, and on a day like today I feel even better about it being able to be on TV.
That sounds like you've got some news to make tomorrow.
I live my life a day at a time, so we'll see what happens.
Secretary Marty Walsh, I think we can read between the lines there. It's good to catch up, sir, as always. The Labour Secretary there, Marty Walsh. Coming up, more data coming in after today's very, very hot jobs number.
It could well be that, you know, conditions are picking up. Employers had positioned for an alternative outcome for things to be slowing down. Now they find themselves having to play catch up to that stronger economic growth.
That conversation still ahead. Plus, iCapital's Anastasia Amoroso, PGIM's Mike Collins joining us, and Mike McKee's going to run back to the studio too. That's next. This is Bloomberg.
It could well be that, conditions are picking up. Employers had positioned for an alternative outcome for things to be slowing down. Now they find themselves having to play catch up to that stronger economic growth. Given what we know about the trajectory going forward, there's risk that employment will remain strong.
Neil Dutter of Renaissance Macro, 517,000 in the jobs report, 3.4% the unemployment rate. You've got to go back to May 1969 and the equity market down 0.7% and trying to stage a comeback. The Nasdaq down by 1.2% in the bond market. Yields much higher by 11 or 12 basis points to 422 on a 2-year, on a 10-year up 10 basis points to 349. With us, I'm pleased to say, iCapital's Anastasia Amoroso, Pete Jims, Mike Collins. To the two of you, just a wow morning, Kay, with the market action of the year to date, and then this morning off the back of a massive payrolls report. Anastasia, you said it, 3 silver linings. I imagine the data this morning backs that up.
Well, it certainly does. And John, I think I said it last time on Payrolls Friday that it was a soft landing type of a report. And this is yet again a soft landing type of a report because we're seeing phenomenal job creation. We're seeing job openings that are still at 11 million. And as a result, these layoffs are not resulting in higher unemployment numbers. So as long as consumers are gainfully employed, that's going to prop up the economy. And I guess the other silver lining is that the wage inflation, 4.4%, a little bit higher than expected in last month year over year, but it's still sort of holding in this 4% range. So that's the silver lining, John. But I do worry that this challenges the view that Fed Chair said just a couple of days ago, which is that disinflation has started and it's soon going to start in the services part of the economy. I think it challenges that view because if you have 11 million jobs out there and people are going to find jobs, that still creates some wage pressure, and 4% year-over-year wage growth is just not good enough for the Fed. So near term, I completely understand the market reaction, and frankly, we've come up a lot in a short period of time, so I'm not surprised to see some of this give back.
Mike Collins, your reaction?
Yeah, undoubtedly a strong number. Obviously we take single data points with a grain of salt, Jonathan, but if you look at the, half a dozen or so last reports, the job growth is averaging, 350,000 or so a month. I mean, you cannot discount that. The sectors that we've seen the most growth in recently are the ones that, believe it or not, still have not gotten up to the level of total jobs since before the pandemic. Things like leisure and hospitality, healthcare, construction, services. We're still short jobs in those sectors. And as we all know, the services sector, the travel sector has legs to it, right? I mean, this COVID rebound has legs and it continues to boom. So this is a really good report for Main Street. This is a really good report for people. And you're seeing the movement in rates and stocks. They're still within the range of the last few days. So nothing dramatic. It's a good backdrop.
And the president agrees with you. He said jobs are going up, inflation's going down. My economic plan is working. You'll hear from the president at 10:15 Eastern time, about 30 minutes from now. Mike, let's take the price action away. The market reaction to the payrolls report from an hour and 15 minutes ago. Let's park that, pretend it's not happening. When you look at that report this morning, does that raise the risk that this Fed needs to go further? Or do you take comfort from the fact that you can get unemployment drop into 3.4% without wages accelerating?
Yeah, I mean, we've already seen a deceleration in the wage growth, right, from the mid to high fives down into the kind of mid fours. And I think a lot of that is the mix shift, right? You're seeing all the anecdotal evidence of these kind of high-paying, white-collar jobs being eliminated from the tech and financial sectors and being replaced with those lower-paying services jobs, Jonathan. So that naturally brings down the overall level of wages, which is good for the disinflationary story. But that doesn't mean individuals won't still have power, won't still have bargaining power to get higher wages. So if wage growth stays in the threes or at 4%, and inflation only comes down to 2.5 or 3, I don't think that's a bad world. Yeah, that's a world where the funds rate has to stay above 2.5 or 3. So maybe the funds rate lands, at 4% for the next few years. That is not a bad world for investors.
We've had a year of gains. For investors, a year of gains in a month. Anastasia, it's what now? What now?
Well, what now? I do think that at this very moment, we are due for some sort of pullback and consolidation because, if you asked me 2 or 3 weeks ago, I would have said, well, we're not yet at technically overstretched levels. And, maybe this market has more room to run, but we are approaching overbought levels certainly on tech and on other parts of the market. And the risk that I think these markets may need to appreciate is there's a risk that with the part of inflation that it has in fact been transitory is the goods inflation, the supply chain bottlenecks. It seems like it took longer to transition, but it seems like it is transitioning away. And that's why the headline inflation is falling as food, fuel, and durable goods prices are falling. But there is a risk that I don't think market participants are really focused on, that maybe there's a secular inflation narrative that is more sticky, and that is wages. If we do continue to see the strength in the labor market, and wages don't go down to 2%, maybe they stay at 4%, that's a problem. And we may end up in a position where, especially as China reopens, and that puts pressure on, the goods sector inflation again, especially via energy. And then we still have this sticky services inflation, and maybe we're not, in fact, on the path to 2%. So that's the risk that I worry about, that the markets sort of need to price in near term. So the view is, yes, there are silver linings. Yes, there's reasons to be more constructive on stocks this year, but it's really difficult to see us go above 4,200 until we convincingly get rid of inflation.
Given what you just said about inflation and the backdrop and what may materialize later in the year, I'll get my words out. It's been a long morning. Anastasia, does that shape your view on what sector you want to be in? Would you fade the leadership in tech you've seen so far this year?
Well, again, it's all about the entry point into the sectors that we like, which I do like semiconductors, I like software, I like real estate. Now that they've run up, in the case of semiconductors, 15% or so year to date, I wouldn't tell you that now is the time to add to them right now. But as things pull back, the type of sectors you do want to buy are the ones that are well positioned for the Fed funds rate to peak and for inflation to sequentially come down. And that brings me to semis. I really like that space because valuations have been cut relative to last year. And semis are very highly correlated with manufacturing PMIs. Well, the PMI data went from 60 to now 46. So we've seen a bulk of the correction in manufacturing. And for that reason, I think we might have seen a bulk of the correction in semiconductors. And semis, by the way, have the sensitivity you want to falling inflation. So I think there's a lot supporting the sector, and especially the secular semis. It's not about memory, it's not about PCs and smartphones, but it's about artificial intelligence, for example. So that's where I would focus within the markets right now. But I would do so once the semi stocks correct just a little here.
Mike Collins, that's equities. Let's finish on credit. High yield spreads have tightened so much, 386 basis points now, Mike. I asked this question of Rick Reeder earlier on. When you started the year, it was buy fixed income. It looked great. There were big yields. Is the same true now?
Yeah, Jonathan, I think in high quality bonds, to Rick's point, we're kind of in agreement with him on this one. There's so much value in high quality interest rates, high quality spreads, but I don't think you're getting paid enough yet to go down in quality aggressively, right? Yeah, the high yield market's yielding, 8 and change, but you do lose some of that to defaults, and we know default rates are going to go up. These higher interest rates, as companies have to start refinancing their debt profiles, and consumers, right? And real estate investors, that is still going to bite. People talk about these lags of monetary policy, and I think the longer that funds rate stays around 5, it really does start to bite. So you're going to see more weakness later in the year. Yeah, maybe it's not the hard landing, and I've been in that kind of soft landing, mild recession camp all along, and it seems like that scenario is really playing out here. So it's not a disaster for high yield, but at these levels, it's not really attractive. But it's a year where you buy on the weakness. You kind of hope for spreads to widen and you buy, because now you have the Fed potentially behind you. To Rick's point again, last year you went from a year where the funds rate went from 0 to 5.
Yep.
That's a year where you kind of sell into rallies. This year, they have 500 basis points of capacity to support the economy if it does weaken. That's a really good position to be in.
Mike Collins, this was great, as always, alongside Anastasia Amoroso. To the both of you, thank you. Bit of news out of Washington. The Biden administration had been weighing whether to postpone or cancel an upcoming trip of Secretary Blinken to China, given the latest news over the last 24 hours that the US had been detecting a Chinese surveillance balloon over the United States. We're getting some news just now. The US to postpone Blinken's visit to China over that spy balloon. So that's the latest news there. One more piece of news. We always knew this. The president watches Bloomberg surveillance. Mike McKee saw that hit of yours at about 8:30 Eastern time, retweeted it and said jobs are going up, inflation is going down, and my economic plan is working.
Very flattered. I guess you can credit the president because the president has to take the blame when things go bad. So, a lot of this has to do with the spirit of the American people, but he can grow today. John, we did have a little economic news while you were talking to Mike and Anastasia. The S&P Global U.S. Services PMI comes in a little higher, 46.8. The composite comes in at 46.8. Those are up 2 ticks. The next thing is ISM, top of the hour.
Looking forward to it. Mike McKee, thank you. Your trading diary up next. "26 minutes in, price action lower. Here's the trading diary. Coming up, ISM Services top of the hour. President Biden, 10:15 Eastern. Fed speak returns with President Mary Daly on deck, plus Fed Chair Jay Powell speaking next Tuesday, along with President Biden's State of the Union address. From New York City, what a morning. Have a wonderful weekend. This was the countdown to the open. This is Bloomberg.
the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Friday, February 3rd. Here are the top market stories we're following for you at this hour. Tech euphoria hits a wall. You got AAA's, Alphabet, Amazon, and Apple disappointing on earnings and their outlook, capping an epic start to the year for tech. And speaking of, you got too far, too fast. Bank of America warns of brutal stock declines as economic growth rolls over. Says sell equities when the S&P gets over 4,200, I should say. We speak to Jonathan Golub, Chief Equity Strategist at Credit Suisse. And way too hot. The job market surprises to the upside, adding a whopping 517,000 jobs in January, putting even more pressure on the Fed. Bonds sell off. From New York, I'm Alex Steele with my co-host in London for the day, Tom McKenzie. Guy Johnson is off. Welcome to Bloomberg Markets. I don't think I've heard this many strategists and economists say the word wow in response to economic data.
There was a collective intake of breath here in the London newsroom when this number came in, 517,000. You have to ask yourself, what more does the Fed need to do to get softness in this US labor market? Levels of unemployment back down to levels, years what? We're seeing 1950 kind of levels, Alex. It's remarkable.
Yeah, I mean, we could point out that wage growth is slowing. I mean, it's still 4.4%, but it is slowing. And then we're seeing the bond market, I should point out, yields are up at 16 basis points on the 2-year. I wonder if part of that is the services data that we're seeing, Tom.
That data coming through now, that is the redhead in terms of the ISM services data for the month of January, rising, wow, look at that, 55.2
really strong
versus 49.2. Very strong. The estimates have been for 50.5. So this is the month of January. ISM Services Index coming in at 55.2 after that surprise contraction in the month of December. And of course, Jay Powell wants to see this persistent trend around services sector inflation come off. The data in terms of ISM Services month of January suggests that there's still some work to go there. Very strong in terms of what is happening in the services part of this economy. Again, contracting, surprising in December, but bouncing back very strongly in January, 55.2. Let's bring in then Bloomberg's Michael McKee for reaction to this. Michael, does this make Jay Powell's job that much more difficult? You layer it on top of the jobs number and then a very strong services sector.
Well, it may not. It's really going to depend on prices, Tom. But, I mean, when you look at the ISM services number, it's another wow number. Not just the headline, but new orders go up to 60.4 from 45.2. A massive turnaround there. And the other numbers come in really strong as well, except for prices. Prices continue to fall, 67.8 from 68.1. So you could argue that it doesn't make Jay Powell's job harder, but it makes Jay Powell's communications harder in the sense that everybody's going to start to believe this idea of a soft landing and the Fed can stop raising rates because we're there, and the Fed is going to look at these numbers and say maybe not. I mean, one thing that we should point out is that if you do a 3-month rolling average annualized of the average hourly earnings on a year-over-year basis, they actually rose. So last 3 months we've seen a little bit stronger wage growth than we had seen, but if it's not pushing up overall inflation, that's going to be still good news.
Yeah, man, that services number, the biggest advance since 2020. That new orders really coming in. That surprise to the upside. All right, let's make this part of our question of the day here. Too hot to handle. Is this job market, is some of the underlying data too hot to handle for the Fed? They're going to have to go even harder to get that job market to come down. Joining us now, Ira Jersey, Bloomberg Intelligence, still with us, Mike McKee. So Ira, let me start with you because I was mentioning, I was surprised the bond market reaction wasn't even stronger to the jobs number than the services comes out, and then we see an even deeper sell-off, 16 basis points higher now on the 2-year. Your thoughts on the bond move, Ira?
Yeah, so the bond move after payrolls was about what one would expect given the strength of that number, and there were some seasonal factors that certainly that certainly mucked up the number a little bit. So maybe it was a little bit weaker than the headline might suggest. But importantly, the wages numbers weren't robust, right? So I think that when you take it in totality, 10-ish basis point sell-off in the 10-year yield made a lot of sense. Now the services numbers are pretty amazing, and I haven't gone into all of the detail quite quite yet, but things like business activity continue to be up, and also export orders up quite a lot. So pretty interesting day to day all around, and just showing the strength of the U.S. economy. So, for 10-year yields, I think we probably test the upper end of the range, kind of 375 to 390 area for 10-year yields in the next couple of weeks.
Ira, are we talking about a terminal rate well above 5% at this point?
I don't think we can get there quite yet. So I think the Federal Reserve will be very happy to hike maybe another, at least one, maybe two more times, and then kind of pause and wait and see. And importantly, and I think for risk asset markets, so when we talk about the stock market and some other risk assets like corporate bonds, if we right now, I think they're so high because the market's expectation that the Fed's going to cut this year and be cutting in 2024. If we just price out those cuts, I think financial conditions tighten quite a lot, and you wind up seeing probably more volatility in risk assets, and that's an environment where long-term bond yields wind up probably doing a whole lot of nothing, but front-end bond yields will move a little bit higher, and in fact that is our expectation after this morning's number.
Mike, 5% terminal rate, is that enough to do it? Does it got to go over 5% and stay for longer now?
Well, it depends on what you're trying to attack. If you think that very low unemployment is going to create inflation, which the old Phillips curve model would tell you, then yes, you're going to have to go over 5% if we keep getting these kinds of numbers. But if you're looking at just the inflation side, and we've seen inflation starting to slow, and maybe putting a little more weight on the idea that it was the supply side that really pushed things up. So we're going to have to get some more data. The good thing for the Fed is, and Jay Powell, is they've got two more CPI reports before we get to the next Fed meeting. So they will have more data on inflation that will give them a better picture.
Am I reading this right? It looks like if you look at the WIRP function, we have now almost priced out any cuts for this year?
Moved to December now.
Okay.
So, it wasn't long ago that they were actually pricing in rate cuts in March. And now we've moved that way back. So,
yeah. Ira, I mean, investors having to weigh this up with that language, and of course the failure of Jay Powell, whether it's failure, whether that's too strong a word, to push back on the question around financial conditions, not easing as much now, that tightness. Is there going to be, do you think, any sense of reassessment of the language that we heard from Jay Powell? And do we expect Fed officials, do you think, to come back out and reframe their communication on this?
Well, so I think that they will, and they have the opportunity to, right? Because we're no longer in the quiet period. We still have about 5 weeks for them to kind of clarify where they're going to go. And certainly when we see the CPI data in the middle of the month, that'll be the next really key number that I think the rates market in particular will hone in on. So Jay Powell was a little bit more dovish. He did make some hawkish comments, saying things like, I don't think that we're going to be cutting this year. The market now is just about price that, although not completely. But more importantly, I think that he did make some more dovish comments, and we actually have a model that looks at of the opening remarks press conference, and surprising to me, that model showed that there were less hawkish statements and more dovish statements in his opening remarks, which is a little bit surprising given the strength of the economy right now. And I think if he had to do it again, and when some of us in one of our client chats are talking about this, if he had to do it again, if he had all these numbers beforehand, he might have said something a little bit differently and been a little bit more hawkish.
Ira, this is Mike. I got a question for you, though. I feel a little bit like Columbo. I'm confused. The Fed chairman came out and said, we're going to raise rates again, and we are going to hold them there. And the market didn't hear any of that. They just heard the parts about inflation coming down. And I'm wondering why there's no belief in that. The Fed is making it clear it's going to be as determined as possible to keep rates up to bring inflation down. And yet people don't want to hear that.
Yeah, I think, Mike, the market's been trained to think that when we have a slowing economy, when we wind up having slower retail sales and real growth going down, that the Federal Reserve is going to cut interest rates. So the market's gotten so attuned to the Fed put and thinking that Fed put is relatively close to the money, that they're going to cut, even if we have just a very mild recession that doesn't lead to any job losses. And taking the market psychology and changing that market psychology is going to take a long period of time.
Yeah.
And I think we're just not there quite yet. And I think that the market's wrong, and the market has to wake up to the fact that the Fed put is still there, but it's just way, way out of the money.
Well, I mean, the market's listening to the data. Maybe not so much Powell, but definitely the data is paying attention to that. Ira, thanks a lot. Super appreciate it. Mike, thank you as well. Ira Jersey, Bloomberg Intelligence, and Mike McKee of Bloomberg. Really appreciate it, you guys. All right, coming up more on the jobs number and the market reaction. We're going to talk to Jonathan Golub, a Credit Suisse Chief U.S. Equity Strategist. And as we head to break, we just heard from Labor Secretary Marty Walsh on that hot jobs number.
I looked at my economist and I said, you were way off today. You know, it was a great report. I mean, when you look at areas that I think are really important, business grew, healthcare grew, education grew, and we saw strong, steady growth in construction. I mean, so those are areas that obviously you would know better than I would as far as signs for the economy and concerns about the economy. But right now, certainly I'll take this jobs report for any day of the week.
Season is here.
Big banks, that was the big story.
From the big banks to big tech.
Everybody is losing a lot of money.
It's a question of how high the bar is set.
Bloomberg breaks the numbers first.
A blockbuster number.
Blowing through estimates.
These guys are minting money with exclusive expert analysis.
Does this approach make sense to you?
We're going to have to make an acquisition.
This quickly become just a really crappy business model.
I don't think their business is as broken as the world thinks.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
This report is a reminder that the hot, tight labor market is still going to be an issue for the inflation outlook and for the Fed outlook. The degree of tightness in the labor market may really challenge the ability of the Fed to deliver that pivot that the bond market's pricing in for the second half of the year.
That was BlackRock portfolio manager Jeff Rosenberg weighing in on this red-hot labor market, which takes us to the question of the day: too hot to handle? And you add in the services number, and it feels really hot to handle. Jonathan Golub, Chief U.S. Equity Strategist and Head of Quantitative Research over at Credit Suisse, joins us now. Jonathan, too hot to handle? What do you think?
Yeah, I mean, I think that those comments were very much on the mark. That the investors right now are expecting, or had been expecting before today's reports, that the Fed was going to have their last move in March. They're going to have an extended pause. and in the fourth quarter, they would start to take interest rates back down because inflation would be under control. And with an ISM as strong as what we saw today on services, and with this jobs number, which was totally on fire, and Thursday's number on really low weekly jobless claims, it appears as if this is beginning to run away from the Fed. And the modest pullback we've had today is probably not enough given this news flow.
Jonathan, is it though, or do we just have to throw out the old economic models and accept that maybe, just maybe this time, you're going to have a tight labour market but wages coming off? Is that unbelievable that we could accept that that is potentially what we're looking at?
And listen, there are laws of gravity. Is it possible that you drop an apple and it goes up, not down? I don't know, but that's just not the way things work. If we right now have, the JOLTS report said that there are more companies looking for labor. The Thursday weekly claims report said companies are unwilling to let go of workers even if they're not happy with them because they know they can't replace them. And today you see that there's a huge number of additional hires. And interestingly, more people are entering the labor market. The participation rate went up. Because why? Wages are going up, and it's telling people, come on, get a job. You're going to get paid more money. So is it possible that you have a red-hot labor market and no inflation? Anything is possible, but it's seeming increasingly improbable.
So, Jonathan, your year-end target for the S&P is 4050, or above that level. So would you be then selling any rallies, and does that apply to, like, tech? Because I think, like, after yesterday, with that NASDAQ 100 up 3%, how are you not tempted to chase that?
Alice, our call, if you look at, when we put out our market target in October, what we basically said was that we were going to have a really, really strong rally in the fourth quarter and into the beginning of the year, and that the first half of 2023 was going to be stronger. Why? Because inflation, and I'm not talking about wages here only, but I'm talking about CPI and PPI are falling really rapidly, and consumer confidence has been rising now for 6 months. The Fed is signaling that they're going to pause in March, and all of this is a huge positive story to draw capital into the market. And it did that all of the fourth quarter, and in the last 4 weeks or so, it's not only brought capital in, but it's been much more speculative in nature. Bitcoin going up, and and speculative companies with no earnings, doing super well. And our take is that ultimately, that if the labor market stayed this hot, the Fed was going to have no choice but to disappoint the market later in the year. And we're pretty much on that playbook right now. I mean, is January a bit stronger, or the beginning of February a bit stronger than I had anticipated? Maybe a tad, but the overall outlook is very much in line. Stronger first half of the year, weaker back half as the Fed disappoints.
Okay, so if you have to have exposure to U.S. equities, where is your tilt at this point?
Well, in the very near term, I mean, look, the other thing which is important here is we're not going to have a recession, or at least we're not going to have a recession in the near term. And if that's the case, you don't need to be in defensive stocks such as staples and utilities and the like. Tech is really doing quite terribly on fundamentals. So while tech companies are ripping on their stock prices, they're having an awful earnings season. And that's true both in terms of their growth rates, massive margin contractions, missing estimates. And so I would love to buy tech. It's just the fundamentals are telling me to stay away.
But Jonathan, then on that point, though, I'm looking at Apple. It's up 3%. Their supply chain commentary and their economics were like really not good. They were weak. The stock was down. Now it's up 3%. How is this making sense?
Well, Alex, if you look at other times that look just like this historically, it's when you're leaving a recession. You've had a recession, it's over, or you've had a major crisis, 9/11, the financial crisis, whatever it is, and you're now on the other side of it, and you're getting this big V-shaped bounce and liquidities flooding into the market, and you have lots and lots of runway for economic success. The problem is that we're getting this V-shaped kind of bounce, but the earnings are decelerating. The economy is relatively punk. The expectations for GDP for the next couple of quarters are for basically zero, or for only 50 basis points for all of 2023. So if you use the other periods where we've seen this type of leadership as a guide, it just doesn't line up with what we're seeing now. And I think people who chase this are going to get really hurt.
Okay, people are faced with pain. 17% rally in terms of the NASDAQ year to date, and we just have Apple as one example today. Even as Apple, or at least Amazon and Alphabet are off in the session, again, investors digesting those results. Jonathan, when it comes to the squeeze on EPS, when do you expect that to bottom? When do you start to see a little bit more resilience in the earnings per share picture?
So let's focus on what the big issues are, and there's two. The first one is that consumer prices or CPI is falling more than wages are falling, which means companies are getting stuck paying higher wages but not being able to pass that on. So there's a general margin squeeze which is playing out in virtually every sector of the economy. However, there's something much larger going on in the tech space where they meaningfully overhired staff, where the expectations on what would happen, the trajectory that we saw during the pandemic, we all extrapolated that, and that's causing a big disappointment there, not only for us as investors, but for the companies themselves. So I think you're going to see really margin weakness throughout the course of the year. The consensus view is that when you get into the third and fourth quarters, we start to exit this type of an environment. It's really hard to be so specific, but our expectation is that we have $215 of earnings this year. The consensus is about $225, and the consensus estimate on earnings is falling like a stone.
Hey, Jonathan, it's really good to catch up. Fun day to talk about it. Jonathan Golub of Credit Suisse. It's good to see you. Speaking of tech, it is 20 past the hour on the West Coast. Let's get to the startup. We cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now, Bloomberg Technology co-anchor Ed Ludlow. Ed, let's kind of start where we left off. Apple's up 3%. Sure. What do you think about that?
Yeah, I mean, as Jonathan put it, these stocks, when you look at the fundamentals, are not doing well, and the stock does not reflect that in its trading. I mean, what we learned on Thursday night is that Apple, Amazon, and Alphabet are not immune to macroeconomic headwinds, right? The Apple call in particular is fascinating because Tim Cook was blunt. Their fourth calendar quarter, fiscal first quarter, would have been much better had it not been for this long list of excuses: supply chain constraints, a lack of demand in China. He even went as far as saying that had there not been supply chain constraints in Zhengzhou in the last 3 months of 2022, they would have seen growth in the iPhone segment. The iPhone segment missed estimates and revenue overall dropped 5%. That's quite an astonishing thing to say, the big but, on this earnings call. But, as Apple has not done recently, they haven't given us any forward-looking guidance for this year, so we don't have a lens really in terms of how that improves.
Yeah, Ed, the China factor is going to be fascinating, isn't it? I mean, just anecdotally speaking to people on the ground, they are ready to go out and spend, certainly, and they're sitting on many of them savings that have been built up over the last 3 years. So we'll see what that ripple across for Apple is going to be. I'm really interested in your views on what's happening in cloud. We had the warning around Microsoft and Amazon coming out, of course, AWS, so important for that business. What is happening with cloud, Ed?
Yeah, look, AWS was the surprise, right? The commentary was very specific. They see growth decelerating in cloud on an ongoing basis over several quarters. We've gone from a situation where AWS had top-line growth of 40%, and that's dropped pretty dramatically to 20%, which is still significant growth. But the thing is that AWS and Amazon has always accounted for the majority of operating income because the e-commerce business is not as profitable, less than profitable. And so now AWS is not carrying the rest of that business. In the fourth quarter, Amazon actually did very well. Sales grew 9%, came in above expectations. There was sustained demand for at least the e-commerce side of the business. It was the weakness of the outlook that spooked investors. We learned that with Microsoft earlier in the earnings season, right? Azure did very well in the quarter just gone, but in the current period, the commentary is around a pullback in corporate spending when it comes to the transition to the cloud.
If we go to Alphabet for a sec, where do you think the biggest problem was for Alphabet? Because in some ways, like Meta was going to help preview that in terms of the ad market. Clearly, investors were still surprised. Why?
I don't have the answer, but that is my answer. I spoke to Ruth Porat on the phone, okay, and Ruth Porat basically says the underlying results reflect macroeconomic headwinds, particularly in the advertising market, weakness in search, weakness in YouTube. But what was strange is Porat told me on the phone she recognized resilience in search, which was something significant to say when the numbers clearly don't reflect that. You know, there's also the financial impact of the layoffs, right? That they're going to book a charge of $1.9 billion to $2.3 billion, and slow hiring at the same time. Those two ideas seem a bit incongruous to me. But I think the point with Alphabet is that it's tightening its belt and refocusing itself for this year. Looking forward, in the earnings statement, they said there might be additional costs associated with the cost reductions. And I said, does that mean more layoffs will be announced down the road? And she said, no. The majority of the layoffs are happening in the US right now, in the current period. They haven't got to international markets yet. They haven't started notifying those. So when they do that process in Europe and other markets, there might be costs that they haven't foreseen. And then, of course, there's AI. You know, a lot of pressure on them to kind of lift back the curtain. And they've been talking up AI for years, but they don't have anything commercialized to show for it. So analysts were really interested in that on the call too.
Yeah, watching maybe for the DeepMind answer then within Alphabet's ecosystem to the response from ChatGPT. Ed, just on the jobs question, you nod to us, you touch on it. Where are we in terms of mega cap tech cutting jobs? Are they almost done at this point?
We believe they're done. I think the thing is that when you think about US jobs data, there are various reasons that the layoffs don't show up. A, there's 155 million jobs in this country, and while the headlines are sensational around tech layoffs, they're a tiny proportion, and we're seeing evidence in other data sets that actually those laid off are finding new jobs quite quickly. But that is the question on what the action the companies take themselves. Are these cuts deep enough? Because I don't think we have the chart to hand, but if you look at the hiring growth over the pandemic era, these cuts do not unwind the growth that those companies saw between 2020 and present day. They became incredibly bloated. These are trims, but they don't reverse the kind of boom in headcount that came with the pandemic and the demand associated with that with consumers. That's what I find interesting.
Okay, yeah, really interesting. There is that context then. Ed Ludlow, thank you very much indeed. Coming up, we are going to be getting more, of course, on that jobs surprise, 517,000 non-farm payrolls. We're going to get the takeaways from Daniel Yanis, co-founder and CEO of Checker, and Kathy Bostianczyk, who's the chief economist at Nationwide. And we are awaiting President Biden's remarks on the jobs numbers. He'll be stepping up to the podium shortly. This is Bloomberg.
hour into U.S. trading session. Blowout jobs, blowout ISM services, and stocks are only down 0.3%. Abigail's tracking the moves for us. Abigail?
Yeah, this may be a case of good news is good news, because at this point we do have stocks well off the lows earlier. We had that S&P 500 down more than 1%, the same deal for the NASDAQ 100. But at this point, really off of those lows, the feeling that maybe there could be some kind of reversal, despite the fact that you have yields sharply higher on those blowout numbers, the suggestion that the Fed is going to have to stay there at the hiking wheel, and the Bloomberg Dollar Index up 0.8%. Now, one reason for this turnaround, it has to do with two big names, or at least two big names. If we take a look at the shares of Tesla and Apple, we are going to see decent gains. Tesla up 4.3%. This on the announcement that the U.S. is going to be extending those EV tax credits. More vehicles will qualify. So using Tesla as the proxy for this, up 4.3%. But take a look at Apple, up 3.6%. This stock had been down despite the revenue growth decline and a disappointing quarter. Maybe some people looking past that, thinking it has to do with the China weakness from last year having to do with lockdowns, that was sort of a one-time thing and that they'll be back full engines ahead. Well, speaking of full engines ahead, on the week we have stocks higher, and that certainly has to do with some of the big tech stocks. If we take a look at what's happening there, we have Meta Platforms up 24% on the idea that Meta is now investable in and the year of efficiency. Amazon, despite the decline today on a disappointing quarter, up nearly 5% on the week. Alphabet, Nvidia, we have also up sharply. And of course, this puts the NASDAQ 100 in a good position. If we take a look at what's happening for this chart, here is the downtrend, last year's bear market. And I say last year's bear market because there's significant signs that it's coming to an end. You first of all have the NASDAQ 100 popping above it, breaking it. You have basically almost a bull market here. Now, the RSI is close to overbought or at overbought on a daily basis, but on a weekly and monthly basis, nowhere near, suggesting that even if we were to pause in the near term, which is not clear if it's going to happen, that the buyers, that they are very much behind the scenes. They're wanting to take this big tech index higher, Tom.
Okay, the NASDAQ closing in potentially on that bull market. Bloomberg's Abigail Doolittle, thank you very much. Now, US Labour Secretary Marty Walsh weighed in earlier on the red-hot payrolls data.
I looked at my economist and I said, you were way off today. You know, it was a great report. I mean, when you look at areas that I think are really important, business grew, healthcare grew, education grew, and we saw strong, steady growth in construction. I mean, so those are areas that obviously you would know better than I would as far as signs for the economy and concerns about the economy. But right now, certainly I'll take this jobs report for any day of the week.
Okay, let's get the employment picture then on the ground. We are joined now by Daniel Yanis. He's the co-founder and CEO of Checkr. It's a company that helps to onboard employees for companies like Uber and Netflix. Daniel, let's start with you. What you're seeing across your business in terms of the tightness of this labour market. Look, the top line, 517,000 in terms of non-farm payrolls. We can have a look at that. Delve down into the micro, though. The data that you're seeing on a day-to-day basis, how resilient is the job market that you see?
Yes, hi. So yes, in our data in the different industries, we see very interesting trends in January. So definitely we can confirm that tech companies are having very low hiring volumes, and that aligns with the layoffs and news. So very low January for tech companies. But tech is a very small portion of employment. And so when we look at the other industries, we have a very large base of small and medium-sized businesses. SMBs have had a huge spike in January, so plus 44% increase in hiring volume compared to December. So we can see a huge spike in small businesses, and also similar trends in the gig economy and other parts of employment. So despite the headlines, we see a very high volume of jobs and a big jump in January.
Hey, Daniel, are you seeing any signs of labor hoarding? And if so, what industries?
So really it's in across all industries. There's still a lot of pressure, not enough jobs and not enough people available for jobs. So that's why I think customers and businesses are still fighting for that labor force. So that's a big trend. I think tech is the only exception, and that might be temporary, but every other industry we're seeing is hiring, is fighting for jobs, fighting for workers.
It's really interesting. In terms of when it comes to technology and within that, we've heard anecdotally people who lose their jobs are very quickly able to pick up their jobs. We're going to cut in at this point because I believe we have the president. Alex, you're going to throw to this.
I'll be short. We'll have some good news. Before I head to Philadelphia, I wanted to say a few words about I think is strikingly good news that we just received. Next week, I'll be reporting on the State of the Union. But today I'm happy to report that the State of the Union and the state of our economy is strong. We learned this morning that the economy has created 517,000 jobs just last month, more than 500,000 jobs in just the month of January. In addition, we also learned that there are 500,000 more jobs created last year than we thought, so the January report is updated. The December report is updated. Add that all up, it means we created 12 million jobs since I took office. That means we have created more jobs in 2 years than any presidential term, than any time in 2 years. That's the strongest 2 years of job growth in history by a long shot. As my dad used to say, a job's about a lot more than a paycheck. It's about your dignity. And 12 million more Americans get up every morning knowing they can provide for their families with the dignity and sense of self-worth that have been missing. We also learned that the unemployment rate fell to 3.4%. 3.4%. That's the lowest in 54 years. In fact, the last time unemployment rate was that low was May of 1969. Think about that. And what's more, Black and Hispanic unemployment are near record lows. This matters. The more working-age folks coming to the labor market looking for jobs last month than have in a long while. That is, remember all the talk about no one's looking for, we need more people coming into the market. Well, more people are coming into the market looking for jobs and getting jobs. A positive sign for the health of the economy going forward. And even as the job market reaches historic highs, inflation continues to come down. Inflation has now fallen for 6 straight months. Gas prices are down more than $1.50 a gallon since their peak. Food inflation is falling as well. And as inflation is coming down, take-home pay for workers is going up. Real wages are up. Wages for lower income, middle income workers have gone up even more. Couple that with a 2.9% economic growth last quarter. And here's where we stand. The strongest job growth in history, the lowest unemployment rate in 54 years, manufacturing rebounding at a faster rate than in the last 40 years, inflation coming down, real wages going up, but moderately going up, not going through the roof, the economy growing at a solid clip. Put simply, I would argue the Biden economic plan is working. For the past 2 years, we've heard a chorus of critics write off my economic plan. They said it's just not possible to grow the economy from the bottom up and the middle out. They said we can't bring back American manufacturing. They said we can't make things in America anymore. That somehow adding jobs was a bad thing. Well, or that the only way to slow down inflation was to destroy jobs. Well, today's data makes crystal clear what I've always known in my gut. These critics and cynics are wrong. While we may face setbacks along the way, and there will be some, there's more work to do, it's clear. Our plan is working because of the grit and resolve of the American worker. We're going to keep lowering costs for families, from lowering costs in health care, prescription drugs, clean energy. Because we passed that legislation, we're going to be rolling it out this whole year. We're going to keep seeing shovels hitting the ground all around the country to rebuild the infrastructure and supply chains, manufacturing more here at home. And in communities across the country that were too easily written off for dead, we're going to not only see jobs coming back, but a sense of self-worth and pride coming back. Nothing worse than when a city has a major manufacturer leave, shut down, and all of a sudden your kid getting out of high school or college says, "Mom, we got to move. Nothing here for me anymore. Nothing here." Well, I'm intent on changing that in the heartland as well. That's how we build an America where we all can take pride in working families have a good jobs and a little more breathing room. And as the economy grows from the bottom up and the middle out, it's my objective for the long haul. Trickle-down economics works for one group of Americans. It doesn't work for everybody. And so this is what it's all about. So I'm heading off to Philadelphia, and if you want to ask me a question about the economy, but I'm not going to answer any question about anything else because you never will cover this.
Mr. President, why did you postpone Secretary Blinken? Take any blame for inflation, Mr. President?
Am I taking blame for inflation? No.
Why not?
Because it was already there when I got here, man. Remember what the economy was like when I got here? Jobs were hemorrhaging. Inflation was rising. We weren't manufacturing a damn thing here. We were in real economic difficulty. That's why I don't. Thank you.
Mr. President, when and how will you remain Mr. President?
You were listening to President Biden delivering remarks on the jobs number at the South Court Auditorium. Very big refusal there to answer any other questions. But no surprise, talking the Biden book, saying the Biden economic plan is working. You just heard him respond to a question saying he doesn't take any responsibility for any inflation that we are seeing, and he says the state of the economy is quite strong. I should point out that we're looking at the stocks erasing any sort of losses from earlier. It's sort of like, is good news actually good news now? Is that how I'm supposed to be reading this? I want to bring it, which leads us to the question of the day. Are we too hot to handle? Is the job market too hot to actually cool down? Kathy Bojancic, chief economist over at Nationwide, is with us now. Kathy, what do you think? Too hot to handle?
Thanks, Alex. Happy to be with you. I do think it's too good for the economy's own good right now. And the issue is that the labor market continues to get even tighter. At a time, yes, we're seeing some disinflation in the economy, particularly in the goods sector. And as Chairman Powell pointed out Wednesday, that's really the first portion of it. But core service inflation is still quite high and can be quite sticky. And when I look at these numbers, while on the face of it seems good news, as President Biden pointed out, but it's just too hot, too strong. And I think the risk is, even though we saw some moderation in wage growth, is that when you have a 53-year low on the unemployment rate and you're seeing job growth that's more than double than what was expected, that could only, at the minimum, keep service inflation elevated. And I think it means that the Federal Reserve has more tightening to go, not less.
So that more tightening, where does that take you? What is your expectation in terms of the added rates that have to come through from the Fed? Because the president seems to be painting this kind of rosy hinterland where you have full employment, very tight labour market, growth and slowing inflation. It doesn't seem like you buy into that.
Well, I do hope it plays out that way. That would be, a great outcome. But, I think you have to be more cautious that it's a bit more complex than that. And to think we could have just this miraculous disinflation and miraculous slowing in wage growth, especially when the labor market's so hot, I think that's a big risk, right? A big leap of faith to take. Mm-hmm. And I think that the Federal Reserve, I think they're going to raise rates. Our forecast has been to 5 to 5.25 would be the peak in the target range for the Fed funds rate. I think it's, at the minimum, it means they go there and then they hold it throughout the year. And that's really been the big tension, mm-hmm. as you know, right? The market's been pricing in Fed easing in the second half of the year. These numbers don't really support that.
Yeah, no, exactly. We are seeing some easing being priced out or pushed out, maybe, so that's something. So we got the really strong ISM services and the jobs data, right? But other economic data is weaker. If you look at the manufacturing ISM, for example, is all of this painting a clear picture, or what are the standout questions?
Well, that's a great question. It is very uneven and a bit confusing because we know real estate's been in a recession for 7 quarters. Manufacturing has been contracting. The ISM manufacturing index confirmed that earlier in the week. Now the ISM service index, that's a bit perplexing. Has been more volatile than what we expect, right? That one dipped below 50 last month and then came roaring back, biggest monthly increase since, I think, June 2020. I would say that also non-residential investment seems to be stalling. So I think it's just a matter of time before the labor market starts to slow and even starts to crack. I don't see how it withstands this, and I think it's too good for now, but we're poised to slow.
Okay, only a matter of time before this labour market starts to crack. Kathy Bojancic, Chief Economist at Nationwide, thank you very much indeed. Right, coming up, Kathy Woods takes a victory lap. She does indeed. Her ARC Innovation Fund is having a hot start as well, jumping over 40%. ETF Friday is next. This is Bloomberg.